Good afternoon, everyone, and thank you for joining Quest for another one of our self-directed IRA Tuesday classes. Today we have with us Richard Wilson, who will be presenting on 10 strategies for short-term rental and Airbnb investing. This is a highly requested topic, so we are very excited to get into the presentation material this morning. I do, of course, always want to start out these classes with some information about Quest. On our end, we are a self-directed IRA custodian. We do have a disclaimer before all of our educational presentations. We are a custodian role, meaning that we do not provide any tax, legal, or investment advice, nor do we endorse or recommend any certain products, investments, or services. So we always want to provide that disclaimer to you on the front end that today's presentation is truly for educational purposes only. It's always important to consult with a financial professional like an attorney or an accountant before entering into any type of investment. Now, of course, just some background for those of you who are newer to our educational platform. Again, Quest Trust Company is a self-directed IRA custodian, but we are also the largest self-directed IRA custodian operating in the state of Texas. While we do operate solely in Texas as far as where our buildings are located, we do have 20,000 active clients across the country. So we are not exclusively doing business in Texas. However, that is just currently where we're physically located. With that in mind, we do have about 2 billion assets under our administration, including cash and non-cash assets. Across our 3 offices in Houston, Austin, and Dallas, we have 100 employees. Now, about a third of those employees are certified as IRA service professionals. This means that they've sat through a certification process in order to answer the questions that they speak to you on the phone about every single day. So we see this number growing over time, but right now about a third of our staff has this certification with us. Now, something I always love to talk about before we get into any type of investment opportunity is the $400 million that we currently have sitting in the accounts at Quest that is currently undirected. These are people who are ready to self-direct their IRAs, who are really just looking for that investment opportunity to come up. So we host a number of different events that might get you in front of the individuals who either have the opportunity for investments or are looking for the opportunity to funnel out that money. So always a great opportunity to mention to you all. We're going to talk a little bit more about the ways in which you can get in front of these audiences. First and foremost, the class you're sitting in today is a Tuesday class that we host every week at 12 p.m. Central Time. This is all going to be focused around alternative investment education. And then, of course, we can answer any questions you may have about how that applies to self-directed IRAs. Now, on Saturdays of every single week, still at 12 p.m. Central Time, we also have a self-directed IRA Saturday, which will also include some alternative investment education from some of the industry's experts in their specific field or asset class. Now, I talked a little bit about some of the undirected cash that we have sitting with us. Now, if you're looking to get in front of the individuals with the cash to invest, whether it's in a self-directed space or not, you should come to our virtual networking happy hour. Now, this is a national happy hour, so we have people tuning in from all across the country who either have an opportunity for investments or have the capital they're looking to invest. This event happens on the 4th Wednesday of every month, and it is at 6:30 p.m. Central, so it is going to be an evening event. It is essentially a Zoom call where you can get in front of these individuals, expand your network, expand your knowledge, and really get in front of the people you need to succeed in your specific asset class. Now, of course, all of these classes are going to be recorded, including today's. They are all live streamed on our YouTube and Facebook, and then they will be posted on those 2 platforms thereafter. So if you ever miss a class, ever want to look back at some of the information that will be presented in today's class, certainly log on to our YouTube page and you'll be able to find that right away. I want to mention as well an upcoming event that we have a little over a month. So December 9th and 10th, we have a virtual event called QuestCon Live, where we will have some of the alternative asset and leading experts come on and talk about not only the 2023 market and where they see that potentially going in the next year, but also the 2022 market based off of what they were projecting this time last year. So we did have this event in 2021 as well. And so we're going to kind of compare the two of the projections and where it actually went. And then we'll see where these industry experts believe we'll be moving into in the coming year. If you want some more information, we have linked this for you in the chat box. Certainly log on to our website, check out some of the speakers and the panels that we are going to have for you to, again, expand your knowledge, expand your network, and get the education that you need to feel comfortable moving forward. Now, of course, all of this information for alternative assets, whenever you're thinking of investing into alternatives, this can all be done personally as well as in a self-directed IRA. That is where Quest comes into play. We do have a team of certified IRA specialists who can go into your particular situation, talk to you about the black and whites, what you're able to do with the account, and how you can get started self-directing today. Feel free to log on to our website, www.questtrust.com. We do have a live chat during normal business hours that is monitored by these IRA specialists who can answer any question that you may have there. You're also welcome to give us a call or shoot us an email. We have your contact information on the screen for you today if you'd like to go ahead and reach out. This QR code will allow you to directly schedule a consultation with one of these IRA specialists to talk into a little bit more detail about how you can get started. Now, with all of this said, we are going to go ahead and get right into today's topic. I am going to pass the mic over to Richard Wilson, who will talk a little bit more about Airbnb and short-term rental investing. Thanks so much for joining us, Richard.
Great, Brianna. Thank you for having me here. Appreciate it. And welcome, everybody. My name is Richard C. Wilson. I started our investor club, the Family Office Club, in 2007, over 15 years ago. And since then, we've hosted 185 live events. We just had a 1,000-person event in downtown Manhattan, New York City. We had billionaire Larry Namer on stage, Mitzi Perdue from the Perdue chicken family there, as well as 50 other speakers. Our next event is in December. We'll have 1,700 people there, including, I think, a person or two from Quest Trust. And we'll have 150 speakers on stage over 3 days. The reason I bring that up and introducing myself is that running our investor club for 15 years is the context through which we've learned how to structure deals, how to source good deals, find off-market opportunities. And a lot of the strategies you see in my presentation today are really taken from helping set up over 200 family offices and helping identify the right opportunities at different points in the economic cycle that make the most sense for an investment portfolio or for a client. So I'm excited to share with you my presentation here today. I'm going to go through, whether you ever want to invest with us or not, I'm going to go through 10 different strategies that are effective in making money within the short-term rental space, often referred to as the Airbnb space, because that's the largest platform in the industry, and share with you how we make money in this space. Part of what we do is run a short-term rental Airbnb investment fund. Get into the details of that later, but to cut to the chase, when investors put money into the fund, they then have equity, they get K1s, and they get quarterly wire transfers. And then after 5 to 7.5 years, or if things go a little bit slower, 6 to 8 years, we aim to double your capital through those quarterly wire transfers, a refinancing, and a sale of some of these assets. And most importantly, we don't charge you $1 of asset management fees or make any money or profit anywhere in the model until you've gotten not only your money back, but double your money back. So let's jump right into the strategies. You can see some of the locations here on the front page of the slide where we already do have homes or under contract to close on one, or we intend to get homes in some of these locations. Not every single one, because we're looking for the best deal possible, not just trying to get only locations in awesome places, but ones that are going to produce high cash on cash and great returns long-term. So first off, you may have invested in a mobile home park that looks like this, and you're probably not too excited to go hang out in the neighborhood for a weekend and maybe relax on this couch and kick up your legs. You may have invested in workforce housing and multifamily properties, but it may not be too fun to go swimming there. One benefit of our space, so when they talk about two benefits, one is more legacy related, more fun, and that is that we're buying assets that you may want to visit. You may not want to visit every asset. Maybe you're not a mountain person, Maybe you're the one person who doesn't like Hawaii. Maybe you don't want to go to, out of 20 properties in our fund, the one location we have in Idaho, for example, right? But they are more enjoyable to use. And when people start making more money and they have their basic needs met and then more advanced needs and more advanced needs after that, typically they look for genuine novel experiences. And then they ask themselves, what's more important? Did I grow my net worth from 7 million to 8 million, or 3 million to 5 million, or from 10 to 20 million? Or is it more important that I still try to grow my net worth, but that I have great, amazing memories with family reunions and quarterly trips with your spouse or extended family, or that you reward your C-level executives at your company with free nights, vacation stays at a portfolio of 20 plus properties, right? Like, the experiences and the meaning behind spending that time with the people that matter most to you can be worth as much, if not more, than investing only on financial returns. And that's one of the benefits of the Airbnb space. The other benefit is that institutions love multifamily properties. They own 25% of all of them. They own about 15 to 17% of self-storage assets, but they only own 2.4% of single-family residential homes, and they own far under 1% of short-term rentals. What this means is that the short-term rental space is not mature and organized enough to accept institutional capital. It's more fragmented, it's more inefficient. It's not developed enough to be taking in $100 million checks often for those people to put their institutional capital to work, like pension funds, endowment funds, et cetera. And so there's a big opportunity here. In 7 to 10, 12 years, there will be a lot more institutional capital here. I don't know if the short-term rental space will get to 3% institutionally owned in the next 7 to 10 or 12 years, while single-family residential goes to 10%. But every day, Goldman Sachs seems to be having some press release of buying a whole neighborhood for $40 million as it got developed by D.R. Horton or someone. And so that's the reason I bring this slide up, is we are ahead of the curve on institutional ownership, and that's going to increase valuations and increase as institutions buy more homes, but also invest more into short-term rental property portfolios. That's going to be wind at our back that help increase returns for investors. There's a few quotes here. I'm not going to read off all the quotes. You can always look these up if you're super curious or want to make sure they're real, et cetera. But Rich Ford from Roofstock, he says, I think it's inevitable that institutions will enter the short-term rental market. AirDNA, the CEO, Scott, says the business model has been proven, and now the opportunity is to do this at scale. And here's another quote from eXp Realty, one of the largest real estate brokerage firms. And they say that experts say the transition for institutions is inevitable and that it may ultimately bring a few perks to the industry. So those are just a few quick quotes. I'm going to pop back over to the stream, make sure there's no questions. Doesn't look like there are any yet. But feel free just to ask questions as they come up in your mind. There's probably somebody else wondering the exact same thing, and then we can address those. I'll check in every slide or two and just make sure there's no big pressing questions. So we're going to go over the 10 strategies now on how we make money investing into short-term rental properties. These are not all of our strategies. There's probably another 5 strategies that we're using in real time, but we wanted to get this recording done for you today in this presentation, in 20 or 30 minutes, and we'll open it up for questions so that we don't take up too much of your day. This here is a picture of our asset in Park City. There's empty lots both to the left and right of it. It's surrounded by trees. When you sit on the porch, all you see is a wall of trees. You feel like you're very remote, but you're actually in a little area called Summit Park, which is part of Park City. And you're about 12 minutes from downtown Park City, about 17 minutes from Salt Lake City. So there's actually people that live in this area and commute to Salt Lake City so they can live more in nature. And it's a really popular vacation spot as well. So the way that we secured this deal is our strategy number 1, an all-cash offer with a quick close. This was a broken sale. So the person was very motivated to close. They needed to buy a property in Texas. They were tired of the hassle of it all. And they still made money if we offered them a lot less than what they were trying to get. So they were trying to sell it for $1.33 million, which is probably a fair price. When they had a broken sale, they listed it for $1.25 million. We went back and forth 21 times in negotiations, and we tried to get it for $1 million flat. We could not. We got it for $1.05 million. And today it's worth between $1.45 million and $1.48 or $1.5. But high earnest money, 12 to 17 day closing, and a 20 to 33% discount is the formula we use for getting properties at a discount, buying all cash. One thing to point out, We bought this property a year ago in one of the hottest real estate markets that the US has ever seen, and in a hot geographical market with Park City prices going up 22% a year. And we still were able to get this massive discount. And right now, the market's more soft. It's easier to get better deals right now than it was a year ago. Here's some stats on the property and the date of our closing. It was 31.1%, the average square, discounted off the average price per square foot of other properties in Park City that closed around that same time. Here's the inside of the property. We replaced that couch with a leather couch. And we also have a 70-inch TV you can't see. It's just below where this photo is taken, but you can see the porch out there. Sits 16 people. The house actually sleeps 14 people. And we try to aim for larger size properties because it is harder to find them if you're traveling with multiple families or doing a family reunion, and there might be multiple people helping foot the bill for that nightly rate, which allows you to charge more. Here's the bunk bedroom. You can see the rec room on the right a little bit there. All right, strategy number 2 is to look for wedding options. Look for a wedding venue, wedding reception. The number one highest grossing revenue property in Sedona, for example, which is a market we're going into now, is a wedding venue. And they get reviews all the time, but they have great weddings and wedding ceremonies being done there. So this is something that we just look for optionality. It doesn't mean we only rent it out for weddings. It just means that it has that optionality. Could also just be a big family reunion, or just good for some sort of private event like a birthday party, etc. Strategy number 3 is one of my favorites. We're looking at 2 different plots of land to do this on now. Basically, we buy 50 to 500 acres and then build out more cabins on it or houses. We try to find something with at least one property on it already, so that some utilities were already pulled to it and it can be cash flowing from the beginning. And then we might add Airstreams or mini cabins or cabins to the property after that to make it more of an income property. It's awesome when there is a option to carve off a tax lot. You might buy 300 acres across 6 different tax lots, and maybe we could make them 6 different income properties and sell half and keep half after putting the properties down. That would allow us to lower our cost basis and drive up returns and drive up the IRR. And one other thing is that when we are looking at properties like this, like one of them we're looking at is 70 acres in the Midwest, has 1 house on it. We could add either yurts or cabins to it. Another one is 150 acres. It has some RV pads on it, as well as short-term rental spaces. And we're looking to add several dozen more locations to that 150 acre piece of land. And so those are opportunities that have a higher barrier to entry. It takes longer to sell a big piece of land. So people are more flexible in the pricing, much more likely to do seller financing as well. And so some of our strategies we'll talk about later work even better with big land plays than just a normal suburbia home acquisition. Strategy number 4 is multiple asset listings combined. So you can see here 6 different tiny homes. These are not ours, just an example of how you can do this, because we are doing this on one of our properties right now. You could sell all 6 properties and they might sleep 4 people each, let's say, and you could sell them individually as sleeps 4. Here's the amenities, here's what's nearby, etc. And for this in a moderate location, it looks like in Canada, maybe you're getting, $165 a night or $180 a night. I'm not sure. Could be a little bit less. But what if you sold all 6 of these and you can sleep 24 people? A 24-person listing in the area may go for a lot more than $165 a night times 6, right? You might be able to sell it for $1,300 a night instead of whatever that math would come out to, around $1,100. So you can sell it at a premium, and not only is it charging more, it's a more unique asset. There's lots of assets in every market that can sleep 2, 4, 6 people, less that sleep 8, less that sleep 10, and then it drops off a cliff. And like in Sedona, out of 2,600 properties on Airbnb, there's only about 2 dozen that will sleep 16 people. So going for larger size properties is important. But if you have multiple properties on an asset, just like on a large acreage play, then you have optionality to rent them as one pod and one listing. So you don't just have 6 listings, you have 7 listings, because the 7th listing is all of them combined. And so we have software that helps us manage if one gets taken offline. That means we can't sell all 6, obviously. as a unit, and so you have to charge accordingly if your real goal is to rent them all out at once. It makes it more of a rare asset, and you make more money as well, and so you're more in demand and you make more money. This is an example of one property that we're closing on right now, November 11th. We sourced a 1-acre piece of land in Sedona, which gets 3 million visitors a year. It's $925,000 to acquire the asset. It has 2 assets on it, $462,000 per house, essentially. So we're getting 2 houses. We'll put a privacy fence between the 2 houses and have 2 different driveways instead of 1 that it has now. And we'll have 2 listings on Airbnb. It is impossible, really, to buy a house in Sedona for $460,000. But when we can buy a couple properties on 1 acre, and we bought it as 1 transaction, but now we'll have 2 properties, then that can make the math work a bit better. We'll have to do a deep value add rehab on these properties. We're going to add extra bedrooms. One of the houses should sleep 20 people. The other one will probably sleep 8 to 10. So altogether, we'll sleep 28 to 30 people on 1 listing and then have 2 separate listings going on underneath it. The 5th strategy here, let me check in for questions real quick, actually. Okay, great. Doesn't look like any questions yet. So if any come up, just let us know. The 5th strategy here is the no fee strategy. Airbnb wants to improve their retention rate, make their customers really happy. They incentivize hosts to make their customers happy. Of course, that's how their wheel turns around. They make more money. They had 100 million stays last year. They have 71% market share in the short-term rental space. If you are a host and you try to use VRBO and then you use Airbnb, it's night and day. VRBO is painful every step of the way. Airbnb makes things streamlined, and they're the market leader for many reasons. Now they have a huge lead on everyone else. And one thing we're seeing, though, is that just like Amazon, Twitter, Google, all these big algorithm tech companies live and die off their algorithms, right? Like Yahoo's algorithm didn't work as well as Google's, and Google surpassed it. And so one thing we're seeing is that Airbnb tells us as a host, we will charge less of a service fee to your clients. If you absorb that fee into your nightly rate, we won't charge you as much of a fee. What that tells me is that their customers would rather not see, oh, it's only $299 a night. And then you go to check out and you're like, what? $600 cleaning fee? And then I have this other $400 Airbnb fee. So it's not really $299 a night. It's really like $399 a night. And now the Marriott kind of competes against it, or it's just weird math. It's confusing and just makes customer less happy. So Airbnb obviously incentivizes us to absorb that fee. So we do that. A lot of people don't do that, but it makes more money if you do. It also, we believe, will rank us higher in the algorithm. So when somebody searches for Sedona, Airbnb, then we will rank higher. But also, one thing that we're using our intuition on is that we are also absorbing the cleaning fee. We look at what it costs us to clean a unit. We look at our average night stay at a property. Let's say that the average stay is 3 nights in Sedona. And we say, oh, okay, well, we were charging $450 for a cleaning. So let's just charge an extra $150 a night, and we'll come out break even on the average stay. And it's just a very clean price for the customer. And so instead of $300 a night, we'll charge $450 a night. And there'll be no extra fees. It'll be super clean math, $450 a night. What you see is what you get. And we believe that the Airbnb algorithm will favor us because of that, because no cleaning fee and no Airbnb service fee are 2 advantages. And we say that in our listings as well to feature it. So that's an important point. And that's just partially us spending, $4 million on social media and Google AdWords and running our investor club, our core business, for the last 15 years. And doing that made us learn a whole bunch about dealing with big algorithm companies. Strategy number 6. This is garage conversions. If you take a house, which is in a place that doesn't get snow, it doesn't get too cold or icy, and it doesn't get scorching hot like where I live in Scottsdale, and maybe the max temperatures are 90, 92, et cetera, then you may or may not actually need a garage for a short-term rental property. And if you can find a 3 to 4 or 5 bedroom house and convert the garage into 1 big bedroom and add 3 sets of bunk beds, or convert the garage into 2 extra bedrooms, and you don't have to touch plumbing, you don't have to touch too much water, and it's not like you're doing a kitchen or a bathroom, ideally, you just make it look like a normal wall and add insulation and air conditioning, heating, et cetera, then it could be a way to add square footage to a house and make the house just worth more. If a house is 600 square feet and you're adding 500 square feet to it, you might add $300,000 of value if it was selling at $600 a square foot. And it might only cost you $100,000 to do that. But more importantly, before you sell it, you'll cash flow higher because now the property sleeps 16 people. It's a more rare asset and you can charge more per night because it's a bigger asset, right? So this is a strategy we're looking to do. We were just touring a couple properties in Florida last week, seeing if we could pull it off with one of them. In that particular market, the prices are still too high. So unless we come in with a very aggressive all cash offer, it wouldn't produce the cash on cash that we need to see for our investors. So 99% of deals we turn down because the math doesn't work out for investors. But we look for all of these 10 value add strategies because remember, in our Airbnb fund through investorresidences.com, we don't make $1 of profit anywhere, and we don't charge you any asset management fees till you've gotten all your money back and then double your money back. And once you have a 2x return, then you're redeemed out of the fund. You're left with vacation credits that you can use at any of our properties. But we don't benefit at all. We just have to work really hard until you double your money. So we're only doing value add strategy deals. We're not buying a suburbia home, putting it online, and then even though we can do a good job operating it, trusting that our operations alone are going to be enough to produce a lot of cash flow and add value. We need to add value to the actual property, or add a number of beds, add a number of units on the land, carve off a tax lot, and do creative things like that to really make the deal work and ensure that as the market gets more and more soft and we get better and better deals, that regardless of what the market does, we're forcing appreciation. And by doing these things, the property will be worth more. And while markets can be volatile over the medium to long term, real estate usually does very well. And we are acquiring houses right now in a market that's way more soft than a year ago. So we're getting some really exciting deals getting done right now. Strategy number 7 is a value arbitrage. So this is going to make the most sense for those of you who have invested in multifamily or storage or industrial or office parks. In those industries, unless you're buying a piece of dirt and building a storage facility or multifamily property, you're probably buying the property based on the valuation of the cap rate of how much NOI, how much profit or net operating income it produces versus the cost of buying the property. So you're buying it on a cap rate and you're selling it on a cap rate, and those cap rate numbers may change based on how big the property is or the time in the economic cycle. What's interesting about the short-term rental space, you can just buy a house based on the value of the house, not the cash flow it produces, turn it into a short-term rental asset and sell it based on the cap rate. So right now, between 6 and 7% and change is the cap rates that houses are going for, which are short-term rental properties that produce cash flow. And so buying something based on a real estate value and selling it based on the cap rate value, or at least having the optionality to, you could always sell it to just another single family residential buyer if your area really just grows and that's the best buyer to sell to or the easiest way to offload the asset. You have that optionality of selling it to 2 different groups: the private equity backed Airbnb short-term rental platform that buys stuff based on cap rate, or you can sell it to the single family residential buyer. And having that optionality to do that can really boost your returns and allow you to kind of arbitrage the fact that you just bought an asset that wasn't made for business use and how you're selling it based on the cash flow of the business. Strategy number 8 is to find off-market deals. This is one of the things that we're strongest on. We have closed dozens and dozens of off-market deals. In fact, most things that we do are not on the broader market. The 150-acre deal in the Midwest that we're going after is not on the market currently. The 70-acre was not on the market. The Grand Canyon property that we own, which you'll see some pictures of in a couple minutes. We own a couple acres right in Grand Canyon Junction. That was off market. We went to some of the best asset owners in that area, approached 5 of them. 3 of them got back to us. One had a crazy price. He wanted to sell to us based on cap rate, but he only had 3 weeks of revenue and profits to show. And we said, no, we're not going to buy on cap rate based on that. The other 2 that were left, one of them wanted to sell it to us based on cap rate at 1.5 million. We negotiated it down to 1 million on the price. And we said, no, we're going to buy it based on the real estate value, not the cap rate, because you've only been operating for a couple months. And that really has helped us. So when you talk to a real estate broker, you may know they don't want to hear creative structures unless the property's been on the market for 4 or 5, 6+ months, or it's a big piece of land that's hard to sell. They don't want to hear your creative offer. They just want to know what your offer price is, when are you closing, what's your earnest money. when you're talking to a CEO or an entrepreneur or the direct owner of a real estate asset, they may be motivated to work with you a bit more, and you can have more custom structures. You can take your time negotiating the deal and take a month to figure out the terms between each other, meet in person, build trust. Otherwise, the broker just wants to say, hey, we got 10 other offers coming in, so just make your offer and don't waste your time. We don't want any creative things going on here. So this is one way we'll really be boosting returns, and it's something that takes advantage of the network effect of what we do in our core business. So you can look me up online, Richard C. Wilson and Family Office Club. We have 22 full-time employees. We've been in business for 15 years. Behind me is one of the books I've written called How to Start a Family Office. I've written 13 books, and we have 1.9 million followers on social media, and we have 2.3 million downloads of our podcast and YouTube channel. We host 15 events a year, and in addition to all that, we own familyoffices.com, billionaires.com, commercialrealestate.com, investorclub.com, capitalraising.com. We own some of the biggest media platforms in the investment industry. And the reason I mention all of that stuff is that there's a big network effect of that in getting off-market deals. We just had someone come to us last week who owns a 7,000 square foot property in Hawaii. We also had someone come to us that said, we own $30 million of vacation real estate, and we'd like to talk about maybe contributing some of that to your fund or selling it to your fund. We had another member who owns only 2 properties, but one is on the lakefront of Lake Tahoe. We had another one who's a father-son. They own $22 million worth of short-term rentals, and they would like to JV and co-invest with us and do a big acreage play where they would put in 80% of their money, and we only put in 20%, don't have to sign on the debt, and they help develop the property over time. We have another one that is in Texas on a lake, and he bought it for $650,000. It's valued at over $800,000, and he's willing to sell it to us at $700,000 and change now. We honestly think it still might not cash flow good enough, so we're trying to get it for less. But the point of bringing up all those examples and all those bullet points of everything we do is like having this big network and this big platform and all of these conferences and 238,000 people on our email list gets us access to things we would never have access to otherwise. And we're not just using strategies on how to source off-market deals, which we have many of, like, oh, let's create a database, a universe of all 100 assets we may want to buy in this state, who owns them, what's their social media account, what's their contact details, and systematically reach out to every single one of those asset owners and work deals. We can do that. But even more importantly is that opportunities come to us when we say on stage in front of 1,000 people, if you have a vacation asset and you're not sure whether you should sell or not, how about you just sell 51% of it to us and you keep part of it? Or sell 80%, sell 90%, hold on to 10%. We'll do the value add work. Or sell 100% of it and then take that money we gave you and take your $400,000 that you got after paying off the debt on that asset we just bought from you and put it into our fund. And now you have access to 20 properties and not access to just one property on a lake in Michigan. You have 20 properties now you have access to, and 20 properties doubling your money. So that's really important to get. I think that some of these strategies we're showing you are very basic Mickey Mouse ABC strategies. Some are more advanced. Some are, when you see the slide, you say, oh, that's a great idea. I could see how that would make money. On this slide, unless you know us and you've been to one of our events, which Quest Trust has been to many, and I believe we have someone from Quest speaking at our annual event in December. Unless you know about that network, it's hard to see the network effect of how we would get off-market deals. And then also, if you didn't know, it helps set up 200 plus family offices for ultra wealthy families. Then you wouldn't know that we've worked a lot of off-market deals for them. So I hope that makes sense, kind of drives home the value on this point. Let me check in. Okay, great. Well, I guess everything is either making sense or everyone is super shy today, not asking a bunch of questions. So I'll just wait till the end at this point, since I'm about 70% through, and then we'll check in to see what questions all of you have. Okay, strategy number 9 is creative investment structures. Every single day of my life, every business day, I can say with 100% certainty, I'm talking to my clients and with my JV partners and employees about structures. Laura from my team is listening into this webinar right now, and we were just talking before this call about the best investment structure we've been able to design in the Airbnb space and for real estate families and 100 million plus net worth families, but also for a $1 million net worth doctor, or a business owner that's worth $2 million, et cetera. We like to do things like seller financing, which is invisible debt. The banks don't see it on our credit reports. And on a recent deal, we did 25% seller financing at a 5.5% rate over 10 years. Makes the deal get done faster, easier, and the banks can't say at the last minute, oh, no, we're not going to approve your loan because interest rates went up and now we're nervous about your debt to income ratio. It doesn't get approved by any third party. It just gets done between the buyer and the seller. We use things such as royalty structures, equity caps, buyback periods. We use things such as buying 51% equity interest or structuring different share classes within an LLC and having it so Class A shareholders get these rights, Class B shareholders get these other rights. And that allows us just to be creative with people. Recently, it took us 11 months to negotiate a deal where somebody wanted to sell us an asset for $3 million. When we really got into it, all they cared about was this one use of the asset. So we convinced them to sell us the asset for $400,000, but they got to keep the exclusive rights of that one part of the asset, even though we own 100% of the equity. They got the usage rights that they wanted, and we only had to pay $400,000 instead of $300 million. That's an example of an investment structure being really helpful. And obviously, in negotiating a lot of deals for our families that we work with and investors we help, we've just had a ton of experience on this. And this year alone, in 2022, in case you watch this years from now, it is November 1st, and year to date, we have $82 million worth of transactions we've closed with our investment clients. The last deal we closed was with a billionaire. It was our 19th deal closed with him, and it was a $22 million transaction. But before that, it was just a $650,000 transaction. And today we had $50,000 come into the investorresidences.com fund, and the wire transfer just came in. And we just got a $1 million commitment to investorresidences.com from a $150 million net worth family. The reason I share all those numbers is that a lot of people say, oh, we're best in class, or we have lots of experience, or we're really good at this. But you don't know the tangible numbers. You don't know if they're just kind of blowing smoke or really have ever done anything. But we've just structured a lot of deals as a big strength of ours, and it's related to getting off-market deals and doing big acreage plays. And it's related to the fact that we double your money before charging you a dollar, because we know investors don't really love it when other people charge them fees before they've made them anything. Maybe your money's still at risk and you're getting charged an acquisition fee, an annual asset management fee, a financing fee, a capital raiser fee, a disposition fee. It's like you're getting feed all over the place before they've even made you money. So far, all they've done is tie up your money so that you can't put it in something else. So if anything, they should be paying you a fee for tying up your money, right? So that's the direction I think the industry is going in the future. Getting someone their money back before you charge them a bunch of fees is going to be the norm for a big percentage of offerings. And we're trying to press the envelope because after running our investor club for 15 years, we've never seen anyone. We don't know many Airbnb funds that exist, period. And then we haven't seen any real estate investment fund that doubles your money before they charge you a fee. Wall Street Journal came out with this article talking about how luxury homes have had the biggest decline in a decade. This is amazing news. This is awesome if you are buying properties right now. Properties are being on the market now for 2, 3, 4 months that used to sell within a week or two. That means it's a better time to buy. You know, like Warren Buffett says, you know, there's blood on the streets. That's when you buy, right? And so some people are like, oh, aren't you nervous about the market going down? Like, no, we're throwing a party because the market's going down. And you know, apologize if somebody just lost their job because the market's going down or something horrible. I know bad things do happen to some people when the market goes down. But inside this bubble of investorresidences.com and building up our short-term rental portfolio, there could be nothing better than the market going down and being soft, because then we can do seller financing at terms at a rate that's lower than a bank rate, and it's simple interest, and we can pay it off early. There's no prepayment penalty, and the interest and principal get paid down in equal amounts each month. You probably know when you get a loan through the bank, if you do a 30-year loan, you're paying like 95% interest up front, just a little bit towards your principal. They're betting you refinance or sell that home in 7 years and you don't pay down hardly any of the principal and you pay them all the interest up front. That's not how it's done when you do seller financing. So creative deals can get done when the market is tough, and all cash offers can get even a steeper discount than we got last year in Park City when the market's tough. All right, strategy number 10. Look for something with unique bones and a theme to it. When people go to Orlando, they're probably going to Universal or Disney, or maybe for a business conference, they'll tack on something fun like SeaWorld. When they go to the Grand Canyon, they're driving through the West on a road trip or going to see one of the wonders of the world, and they're in the West. And we have a trading outpost that's turned into a property, an Airbnb property. It sits on 2 acres. You're looking at a picture of it here. There's this front property, and there's another property right in back of it. So it wasn't like we just put 4 pictures of the Grand Canyon on the walls inside and called it themed. The building itself has unique bones to it and looks like a trading outpost because it was one for 50 years. It matches why they're traveling there, out to the West and the theme of the local area. It's unique in size, and it's the most renovated property in the Grand Canyon Junction area, and it sleeps 22 people. It's night and day bigger than others in the area. And in the first 24 hours that the listing went live, we have a wedding reception booked and a wedding reception inquiry because of the size that it can fit. Over 1,000 people a month look for a Grand Canyon wedding, and they need somewhere to sleep those wedding parties. We're going to be one of the top options when people look for that. And over 3 million people a year, almost the exact same number as Sedona, go to the Grand Canyon every year. When you go inside, I'll show you some pictures of it. There's a dress-up experience, but cowboy hats on, some fake rifles, leather vests, etc. There's slingshots for the kids, and the property is real nice inside. Let me skip ahead to show you the inside. This is what it looks like inside. So very well renovated. You can see the kitchen's great quality. It's the bedroom. It's got like a floating bed. You can barely see the bottom of the bed there, but it's floating on a metal support beam in the corner. So very well renovated. But when you look at the outside, you say, oh, wow, this is a really rustic place. I wonder what the inside of that thing is going to look like. Obviously on Airbnb, you get to see what the inside looks like. Here's some details on this purchase. I said next purchase, but we bought this last Tuesday. So I need to update the title of that slide before our next webinar, obviously. But it's a 2-acre property. It has 2 properties on it, but remember that gives us 3 listings. So we can rent the back one that sleeps 10, the front one that sleeps 12, or rent both that sleeps 22 people. We've had over $50,000 of bookings since the listing went live on Airbnb 3 weeks ago. Before we closed, we were able to start taking in bookings. We've had over $50,000 in sales that roll in as people stay there. The asking price was $1.5 million. We negotiated it down to $1 million plus the cost of furnishings. It was an off-market deal. As I explained earlier, we went to find the largest assets in the region that we think would perform the best and approach them directly versus just saying, oh, what's on MLS? And then us and 20 other people are chewing on it and they won't take a creative offer. Doesn't make as much sense, right? On this deal, we got 25% debt at a 5.5% rate. My team and my investors know I'm very conservative. I'm not a super aggressive person. That's why we chose this niche and not a crypto fund or a venture capital fund or an angel investor seed capital fund. We like things that are cash flowing, hard assets, and we like things that we get it all properly insured with a rider. If it has a hot tub, we get a hot tub rider on the insurance policy. So we covered on air pollution. If the asset goes offline, the insurance policy pays us the revenue we should have gotten those months when it's offline. If I and my whole 22-person team died in a plane crash, then this property could be that somebody within the fund would be elected to represent the limited investors in the fund, the LPs, and then the assets could be sold off, or you wait till the market corrects and then sell off the assets. It makes it very unlikely that you can lose money in this type of a structure because it is so conservative. And on average, we're taking around 50% debt LTV. In Park City, we own the home cash, free and clear. This property, 75% equity, 25% debt. On the next property, we're looking at maybe 60% debt. And on average, it'll be 30, 40, 50% debt on most of the properties. There is an opportunity to add an extra unit in the back of this one because it sits on 2 acres. But for now, we're probably not going to do that because we could buy land next door or across the street and build out additional units there instead. And in the backyard, we're making a adult trike. It's like a 3-wheeler that's low to the ground, not a bicycle. And we have a dirt track that we're building out in the back that goes through the trees and around in a nice loop with a checkered flag for the finish line. And we're building a play structure back there. And there's an old caboose in front of the house you can't see here. So making it a really fun property for families, family reunions, wedding receptions, etc. And this is another example of buying something based on the real estate value and selling it based on a cap rate one day as our goal. pictures of the inside that you saw. So to summarize our strategies for Airbnb investments and what we're doing at investorresidences.com is we provide exclusive experiences to your family, which may be more important, like all else equal, creating memories that your kids will never forget, or rewarding your employee of the month or your office manager at your medical clinic with a trip that their family will never forget, can build such goodwill and good memories that if you had to, it may be worth only making 1.5x on your money versus 2x in some other deal, because of the value of those memories being worth more than the money. Even if the deal just broke even, it may be worth investing in, because what's more important in life than great memories with the people who matter to you most? But I don't think you have to sacrifice that. Our deal is conservative. We're not going to 10x your capital. I can promise you that. We're not aiming to 5x your money in 5 years, or blow your minds and blow your hair back with like amazing venture capital type returns and 20x your money. That's not us at all. We want steady cash flow, doubling your money. We hope in 5 to 7.5 years. If it takes 6 to 8, then it takes 6 to 8. We're aligned in that we make no money until you double your money. And we'll raise our next fund faster the better deals we get in the portfolio and the faster we double your money. So it's good for you. It's good for me. It's good for my whole team if we can double your money sooner rather than later. But we want to have proper insurance, we want to have proper property management, and we want to do an excellent job running it as a stable platform that's growing. Our intent is to build an institutional platform long-term with hundreds of properties in it. And if you invest in this fund, you'll have equity in 20 plus Airbnb properties that will be producing cash flow and be diversified in different markets. So if there's a fire in Lake Tahoe, maybe it takes down 1 or 2 of our 20 assets, which would be insured, but it's not taking all the properties offline. And because our debt is moderate to low, would still be cash flow positive, even if there was 2 forest fires in 2 markets and it took off 4 assets out of the 20, would still be with a short-term revenue replacement insurance policy. And even if that didn't pay out for some reason, would still be cash flow positive. So that's important to us. The 3 benefits are really exclusive experiences, appreciation, and an inflation hedge. Maybe Biden wants to get reelected by printing another $1 trillion. Well, that would cause massive additional inflation, as most of you know, and real estate prices would go up again, and the Airbnb nightly rates would go up again, and that would help the value of our portfolio and help you double your money. And then we are forcing appreciation and value and growth and value by converting garages and adding extra units to acreage, et cetera. And you're getting your quarterly profit share and your quarterly wire transfer along the way as we 2x your capital. It's important to understand the 2 phases of the investment. Phase 1, you're getting quarterly wire transfers as we go to double your money. In the 5 to 7.5 year time window, we'll sell off a third to half of the properties, refinance the remaining set of properties to get you your 2x return. After you have doubled your money, phase 2 is you get a vacation credit, and you basically get to stay at the properties, and you have $600 a year of vacation credits for every $25,000 you invest. Most investors put in anywhere from $75,000 to $200,000. Those who are worth 5 to 10 million or more are usually doing $200,000 to $300,000, and then family offices, single family offices, are typically doing $500,000 to $3 million allocations. Just to give you an example of how people are looking at this, everyone we talked to has essentially said, "Oh, I've never seen an Airbnb investment fund, and I've never seen a fund that doubles my money before they charge us anything." So most important slide probably of the whole deck here is our team. We have 22 professionals on our team. 1/3 of them are from hospitality. 3 of them are licensed real estate agents. Jen Myers is from 3 different short-term rental background companies. One is a luxury villa in Hawaii that was 14,000 square foot, where she managed the property on site for vacation rentals. She then worked at the publicly traded company Inspirato, which manages over 550 luxury vacation homes. And then at Avant Stay, that manages 700 plus short-term rental properties. She saw our business model at Investor Residences and came to us in February this year. And she said, "Hey, is there room for me on the team? I'd love to join you because I like what you're doing and what you're building, and I want to help." And I said, "Well, we're not really looking to hire anyone until September full time, but let's get to know each other a little bit." We had a couple of interviews. The team interviewed her, and she was so excellent. We said, "Okay, we're just going to bring you on 6 months early, and you'll just help us be that much more prepared and get our data sets and our filters and underwriting dialed in." And so she's been an excellent addition to the team and is really a deep industry expert for 15 plus years in the short-term rental vacation property space. So lots of investment companies you talk to might have 4 professionals, 6 professionals, unless they manage a $500 million or more in capital, they probably don't have a 15-person or a 22-person team. And that's really one of our strengths. So this is what we can do. If you are working hard in life, but then your capital is not working for you, and you're like most investors, you're sitting on some cash in a solo 401k or self-directed IRA, you're sitting on some personal cash, et cetera. We can put your capital to work for you and get it sweating for you in a way where you're not losing sleep at night that, oh, I hope that the crypto doesn't go down by 90%. Or I hope that that company I invested in, the CEO doesn't get cancer, God forbid, or something happened to him health-wise, and now the company goes out of business. We try to avoid binary investments for our investors, and we see these as hard assets that are cash flowing in high value destinations. And we're motivated to earn a great return while not taking great risk. So that's important to know. We're purchasing real estate based on the value, the sales, and we're selling it at a cap rate value. We're buying it on a real estate value. You're getting the quarterly cash flows and then a refinancing and partial sale of the assets to double your money. You can stay at the properties one night a year for every $25,000 you invest, but that's only if you do not invest through your self-directed IRA. Through your self-directed IRA, there's no vacation stay allowed, so we don't want to get anywhere close to violating personal use of assets. So just keep that in mind. So you'd just be getting a 2x, doubling your money, cash on cash return as a passive investor through your self-directed IRA accounts with Quest Trust. And in summary, we try to design something that was super unique. It's Airbnb and 2x your capital before you make money. It's low risk, moderate to high return, and probably one of the most fun assets within the portfolio. And if you want to learn more about investing in the short-term rental space, you can ask us questions right now here live. If you want to ask questions privately, you can do so. I'll give out my contact details in just a second here. But we're always happy to answer any questions you would have to convince a $100 million net worth family to invest 7 figures into our portfolio and secure the $500,000 check we just got last month from an ultra wealthy family. We've had to answer just about every due diligence question you could possibly think of asking. So we have a ridiculously long email that's more than you're going to want to read. We have a background check from VCheck that I've paid for myself as a $1,700 background check. They do 30,000 background checks a year. You can call them and make sure I didn't make up a 17-page background check on myself. And we have all of that due diligence in place that we can send you. My name again was Richard C. Wilson. My head of investor relations is Laura Clay, in case you interact with her. My phone number, if you want to text message me anything privately about next steps or an asset you own that you'd want to sell to us or JV on or to invest with us, you can text me at 305-333-1155. My email is richard@investorresidences.com. And there's a little QR code here on the screen that you could use to book a meeting. But if it's easier just to text me, that's totally fine as well. So I'll pop back over now to any questions that have come up. If anybody has them, I'd be happy to answer those now at this point.
Yeah, so we did have one. We actually had a question ourselves. I think you potentially have answered it whenever you went through the Airbnb spiel regarding the fees that they charge. Do they have larger fees than your other competitors like VRBO?
All the fees are pretty comparable. Airbnb has a better insurance coverage and better customer service for getting back to you on any insurance issues or damages to properties, but they're all pretty comparable. Airbnb has scaled it so that they have, they're doing 5 to 7 times the business of these other platforms. So I think they are able to charge the same, but offer a better experience because they're making so much more money.
Okay, great information. We do have one question for you as well. Sure. Put it up on the screen. It sounds like once the 2x is returned to investors, the investor no longer has an equity interest. Is that the case?
Correct. Yeah, that's exactly right. So you come in, you have an equity interest, you get your K1s every year until you double your money. At that point, your equity is redeemed out and you're no longer an equity holder in the asset. So that is correct.
All right. Now, do we have any other questions for Richard Wilson today? Now, there was quite a bit of valuable information to take in. I know certainly on whether you're investing personally or self-directed that you you're most likely going to take a lot away from this today. But we did put your contact information in the chat box as well. So feel free to shoot Richard an email, scan the QR code if you want to learn a little bit more from the experts themselves.
Great. Yeah, appreciate you having me here, Brianna. And we have 15 live events a year. If someone wants to get to know us better through a live event, you can reach us out to us that way. I'm based in Scottsdale, in case anybody is local here and would like to get a cup of coffee with myself or Laura. Half of our team is in South Florida, and most of our live events are in California, New York, and Florida, sometimes Texas. So we're happy to keep in touch. And if anyone has questions, yeah, feel free to reach out privately, and happy to answer those for you.
All right. Well, thank you so much, Richard. It is a pleasure having you on the platform. If that is everything, if there are no more questions from the audience today, then we thank you again for joining us for another one of our Tuesday classes, and we will see you same time next week.
Bye, everyone.